Now, Bob, before they got to our video today, they probably heard Dave Ramsey say some horrific things about reverse mortgages. So what would you actually have to say to that?
I like Dave Ramsey. Dave Ramsey has some good advice, and he has really saved some people. In fact, one client that I have out of Arizona specifically was in very bad shape, and Dave Ramsey advice helped him and his wife get out of debt. But after they were out of debt, they were in the position where they had all of this equity in their house and they had no debt, but they still wanted to have some more access for money to spend and to prepare for the emergencies that might pop up in the future. One of the things that Dave Ramsey talks about is not wanting to go into debt. There's a difference between good debt and bad debt. In other words, you're in a position in life where you can pull from many different directions. You can pull from one bucket of savings. You can pull from a reverse mortgage. You have that opportunity to draw from different sources. But I also think it's somewhat bad advice in the sense to say that you should not get a reverse mortgage, you should not be able to pay off these existing loans, because home equity is the number one asset that most people do have. So to ignore that asset is, to me, seems like it's bad financial advice. What do you do with an asset that is totally illiquid? Well, with the reverse mortgage, you can take that illiquid asset and make it liquid so that you can use it at some point in the future.
Welcome to the Prepare to Compete podcast, where we talk all things VA benefits, real estate, and entrepreneurship. Today, I'm actually here with a special guest, and we're going to be talking about reverse mortgages. So, we have quite a few veterans who are retired. They may be on a fixed income, and they're really just trying to decide on how to actually manage their finances. So this is going to be a very good option for them. So today I want to introduce to you Bob Miller. Bob, how are you today?
I'm doing real good, and thanks for having me here. I really appreciate the opportunity to be here and spread the word, because when I learned about these things, I thought they need to be talked about from the rooftops, and why is any more screaming? So I appreciate being here and having the opportunity to scream from the rooftops.
So one of the top questions that they have regarding reverse mortgages is, how much can they actually borrow?
Well, that's not an easy question to answer. And what the borrower needs to do is get together with a loan officer, and the loan officer will be able to ask them questions about what's the value of their house, what kind of mortgage do you have on the house, but mostly important is the borrower's age. For example, if you are 65, you are not going to be able to borrow as much money as if you were 85, because the chances of somebody who's 65 living longer than somebody who's 85 is great. There's a chance with a reverse mortgage, if you get it at age 65, you could end up living there for another 30 years and not making any payments on this loan whatsoever. So it's going to take longer for the lender to get paid back, because you only pay back the loan when you either die, sell, or move out of the house. Now, you can always make payments in advance, but that's truly your choice. But from the lender standpoint, they're going to assume that you're never going to make a mortgage payment on this, and they're not going to get repaid until you die, and that might be a while before getting paid off. So to more answer the question, it depends upon their age, and in the case of spouses, it goes on the younger spouse age, because if one of the spouses was to die, the remaining spouse, the surviving spouse, would be able to stay in the property until the day they died, moved out, or sold the house.
Oh, wow.
So and in fact, that's changed. Recently, years ago, when they first originated, that wasn't true, but it is true today. And that's one of the myths that's still going around. But the surviving spouse can stay in there till the day they die. So they're not able to loan as much money to somebody who's younger than somebody who's older. So that's the reason you need to get together with a loan officer and find out specifically the answer to that question.
That leads me into one of my other questions. What are 5 myths that people have regarding reverse mortgages?
I love this one. And I think the biggest myth I come across is the bank owns my home. You're signing over your house. And that's just not true. A reverse mortgage, a HECM loan, this is an FHA loan now. This is just a loan. So at some point in the future, when you either sell, move out, or die, your heirs or you is just going to ask the mortgage company for a payoff statement, and it gets paid off. So if your house is worth $500,000 today, and you end up selling it, or it ends up being worth $800,000 years down the road, that equity is yours. It's not the mortgage company's. You only pay the mortgage company what you borrow plus any accrued interest. The bank can kick you out. No, the only way you can be kicked out of the house or foreclosed on is if you don't pay your taxes, you don't pay your insurance, and or if a tree falls down on the house or it burns down, call the insurance company and have it fixed.
Absolutely.
But to say that it's unusual in a reverse mortgage that you're going to be kicked out of the house because you don't pay taxes, even if you didn't have a mortgage at all, if you didn't pay taxes, you can get foreclosed on by the county.
Yeah, a lot of times there's just so many different myths, right? And, people just kind of believe what they hear from their comrades and different things. So, no, this is great. So those are 2 myths. So I guess you have 3 more here.
Yeah, I've got a couple. Let me pull out my cheat sheet here and let me put on my glasses. There's a good one. A reverse mortgage is for people who have no money. And I hear this quite often. I don't need it. And there's a lot of deals that I do with people who don't need it. For example, this is a financial planning tool. This is a way to plan for the future. And I was just talking to somebody today that she is concerned about having money for assisted living when she gets older. And this is common with couples as well. So the fact is 70% of us do not buy long-term care insurance, including myself. I didn't do it because when you do it, that's something you buy when you're 40 or 50 or even 30, but you don't buy it, and it's not economically possible to really buy it when you're in your 70s or even 80s. Absolutely. Or even the 60s. It's just the premiums are astronomical. So what do? You've got this equity in your house. So what people will do is they will create the reverse mortgage to create this line of credit so that they can take care of any assistance that they might need in the future that's not covered by Medicare.
When you think about it, not everyone has children they want to pass their home to. Not everyone has children, right? And they definitely might not have children they want to leave, a $500,000 home and $500,000 worth of equity. So when you're considering taking out a reverse mortgage, you're considering the quality of your actual life. And you want to leave your children different assets and things. But if you really think about it, let's say you borrow and take a reverse mortgage and you take out $100,000 or $150,000. Well, that mortgage that they inherit is going to be a lot less expensive than them buying their own property, right? And if your children are working with me anyway, they wouldn't have to worry about that anyway because they already got their own home anyway, right? So, that definitely makes a lot of sense there.
Well, and the sense that you're stripping the equity away in that argument as well. One of the parts about that is, of course, if you borrow money, you're going to be paying interest on it at some point in the future. So, yes, if you never make a payment on it, which you can, but if you never do, you're able to defer that in the future. And yes, it is more of a lien on the house. But what's not taking into account, and most people do, is the appreciation factor on real estate.
Yes.
Now, if we look at any 20, 30-year period in time, real estate's gone up 3 to 4%. I think in the last few years, it's gone up faster than, say, 3%. Now, in the next few years, is it going to go up that fast? Personally, I don't think so, but I've heard people say some strong arguments that it is going to go up. And I think it really probably depends upon where you live at in the country. So that's another factor that people aren't counting on. So when you cross that line of equity actually going down, it depends upon how much somebody borrows. Because if they create the reverse mortgage just for that line of credit and that appreciation factor still keeps going up, then your equity position is enlarging and you have access to money in the future. So it's a financial planning tool, and it's not always just strictly eating into equity, but it's quality of life as well. I run into people who are on the other end of the spectrum. They need money. They do not have enough money to cover for their basic needs. And with the reverse mortgage, they're able to finance themselves. Now, what's right? Is it right to tell a senior citizen that they need to stay living in their house and cutting back on their life, cutting back on maybe their medication and just the quality of life? Or is it say, get a reverse mortgage, have some money in the pocket, do a few things to enjoy yourself and live life better? Because if the objective is to die with the most amount of money, well then, yeah, maybe the reverse mortgage isn't the right thing. But if the objective is to live life to its fullest and being able to utilize and tap into all of the assets that you do have and all the equity that you do have, being able to pull earlier, like I was saying, being able to pull from your savings, being able to pull from a reverse mortgage line of credit, it gives you a little bit more freedom to be able to live life well.
There's so many myths out there again, and sometimes we're just not informed, right? So, you had those myths there, Bob. Is there any other kind of myths and things that they might want to know about?
Yeah, I think you alluded to it earlier. And what we're talking about here today is the FHA HECM loan. Now, the term reverse mortgage is not proprietary.